Hello and welcome to our 2012 budget briefing. There are two main points of yesterday's announcement that we want to cover today. Firstly, Sophie's going to talk about the impacts on income tax and anti-avoidance, and I'm going to come on and talk about stamp duty land tax and residential property. So first, over to Sophie.
Thanks, Chris. Yesterday's budget contained a number of measures which I think we already knew would be in it, and a fair few that we didn't know and which were surprising. Probably the most headline-grabbing is the reduction in the 50% rate of income tax to 45% as of next April, which is clearly a welcome measure. However, that is offset by a number of other measures, and I think it's important to look at them in the round. Probably the most important measure in relation to income tax, aside from the reduction of the 50% rate, is the fact that also, as of next April, there is going to be a significant restriction on reliefs against income tax. So that is, if you're looking to claim uncapped reliefs in excess of £50,000, they will be restricted to either £50,000 or 25% of your income, whichever is greater. This won't apply to things like pension contributions and EIS because they're already capped, but it will probably hit charitable giving really quite hard. And I really do hope that the discussions that the government's going to have with philanthropists find some way of mitigating that, and that is definitely one to watch generally. Moving away just from restrictions on income tax reliefs, we come to the General Anti-Avoidance Rule, or GAR. Now that's been mooted for quite some time, and Graham Aronson QC produced a report last December which outlined the basis for a very sensible sounding GAR, and if that is indeed what's taken forward, that may well be a good thing. Indeed, the CBI came out a few weeks ago and said that a sensibly framed GAR would add to the UK's credibility, and that seems entirely sensible. However, and it is a big however, there was an awful lot of talk yesterday of avoidance and evasion being the same thing, and an awful lot of talk too of retrospective legislation. This does certainly give one some cause for concern about the GAR, and I think it really will be important that it doesn't catch legitimate tax planning. And in that respect, I think it would also be really helpful if we saw some move towards a clearance procedure so that taxpayers could know what is and what is not caught by the GAR. And I must say in that respect, talk yesterday and more recently of retrospective legislation about aggressive anti-avoidance is worrying, particularly since there seems to be a tendency at the moment to talk about avoidance and evadance in the same breath. So hopefully we'll get a focus GAR that actually gives certainty, and let's see what happens there. On that note, I'll hand over to Chris, who's going to talk about stamp duty and anti-avoidance.
Thank you, Sophie. As part of the leaks before the budget announcement yesterday, George Osborne has said he was going to come down like a ton of bricks on offshore companies that owned UK residential property, and he certainly delivered. From today, stamp duty land tax on purchases of residential property above £2 million will be payable at 7% by individuals. That's an increase above the 5% that's currently payable above £1 million already. In respect of offshore companies, if offshore companies buy property over £2 million, they will pay SDLT at 15%. This is not a measure designed to raise revenue, it's a measure designed to deter that as a holding structure. Our feeling is it should be pretty effective at that. That's not the end of these rules. There's obviously the question of all the properties that are currently owned by offshore companies. No new rules are impacting from today, but from 2013 there'll be two new rules. Firstly, a large annual charge on residential properties owned by offshore companies. That will only apply to properties over £2 million, and we'll have to wait to see how they intend to value those properties. Again, the quantum of that charge will probably not be on the same level as a wealth tax in the continental model, so 0.5%, say, but is likely to be more of 2 or 3% order to discourage the ownership in that structure, to encourage them to be unwound. People who own properties through offshore companies will have a year to unwind those structures, and there is an added incentive for them to do so in the short term, because also from 2013, capital gains tax will be applied on the sale of properties by offshore companies, in a way that is not applied to any non-residents at the moment. Going forward, this is going to put a lot of emphasis on changing property ownership structures, with many more people looking to own properties in their own names, rather than through companies. So that's our summary of the two main measures that were announced yesterday. There are many more announcements also made, and for our full detailed analysis, please see our briefing paper that can be found on our website. The address is on your screen now. Thank you.